We're living in historic times. What's happened in the last 3 or 4 years since the passage of the Jobs Act of 2012 is a once in a many generation experience, and I don't know that all of us here really grasp how significant this is. And what we certainly don't grasp is the magnitude of the change and the many different aspects. We've talked about a lot of different things over these last few days that are changing, but there's an enormous convergence happening between the public markets and the private markets. I've operated in the private markets for 30 years in real estate syndication, venture capital, hedge fund management, and I've seen nothing like this ever before. All of a sudden, the professionals who are in the public markets want access to the product that we're preparing in the private markets, and us guys in the private markets who want to work with the people who are in the public markets don't understand them. So they don't understand us, we don't understand them, and there's a tremendous opportunity all the way around. So what's happened? Number one, the biggest change in the securities rules in the last 80 years has just unfolded, and we're all part of that revolution, and it's remarkable. It's exciting, and it opens up opportunity like none of us have ever seen before. The second thing is, who should the biggest beneficiaries of this be? And I'm referring mostly to Title II, which is the general solicitation rules. The biggest beneficiaries should be the professional fundraisers, the small syndicators who raise money on a recurring basis. But that's not what's happened at all. What in fact has happened is that the people that we thought would lose, who are the intermediaries, remember that the concept of crowdfunding is all about disintermediation. It's all about democratization of access to capital. We've all heard about that. I don't believe that in fact has really happened. And that's because the people who thought that they were going to lose, which are the venture capital guys, they all thought they were going to get beat out. We just heard that a big deal happened that didn't happen through the venture capital channels because people now can name their own price and they can do their things their own way. So what did the venture capitalists do to make sure that they kept themselves in the loop? They invested in the platforms. And by investing in the platforms, they in fact created platforms that function very much like institutions. So when you go to these platforms, primarily for real estate transactions, they function a lot like banks. They evaluate us like banks. They look at deals a lot like banks. So the syndicators, in fact, are not getting the benefit that we all expected that we were going to get. So here's what happened. Although it's a great concept for serial fundraisers, and we have a lot of serial fundraisers, a lot of us are serial fundraisers, but in fact, we're not getting access to the capital because the technology, the marketing, these issues are not really core competencies for syndicators. And we go to the platforms and ask them for their help. Generally speaking, the deals that we bring them are not the deals that they want. Why don't the deals work? Why can't we work with the bigger platforms? Number one, their deal typically doesn't work for us. They probably want too much on the front, they want too much on the back, they want too much control of our transaction. Now that might be fine if you're not a professional deal maker, but if you're a professional deal maker, you in fact want all the control that you're used to having. And so for all those reasons, syndicators are probably not able to work with the big platforms. The other reason we can't work with the big platforms is they brag that they turn down 99% of the deals. Now, whether that's true or not, whether it's marketing, whether it's exaggeration of numbers and statistics, we don't know. But what we do know is that they don't like deals with hair on them. They want things that cash flow, they want deals that are easy, they want deals that they can make look good to their investors. That's what they want. And in fact, part of the reason is that they're not real estate people. Most of these platforms are not run by real estate people. There's only one that I know of that's really run by real estate people. Most of them are run by technologists, bankers, real estate brokers, none of which are really real estate people. They're not deal makers who are in the trenches doing deals every single day. And what you have to know is that guys like us, syndicators, make our money on hairy deals. The uglier the deal, the more money we make. And our business is about adding value to transactions. Isn't that what we do? We add value to transactions. If you buy a AAA apartment building, what do the investors need us for? They don't need us very much, but if we buy a building that needs to be repositioned, reorganized, rehabilitated, refurbished in some way, there's a lot of dollars for us to share with the investors. And that's what we really want. We want those hairy deals. So how is it possible for syndicators to participate in this revolution, this once-in-a-lifetime revolution, if the gates to this brand new or 3-year-old business are already closed? How is it possible that a business that's so new could box so many of us out? Well, I decided that that wasn't okay for me. And I put a group of guys together, and right now our group's at 35 promoters. And I said, listen, why don't we build our own platform that works just for us? It's not open to the public. It's a closed environment only for professional deal makers. And by creating an environment that's only for professional deal makers, we can control the quality of the deal. We can keep track of each other. We can make sure that each other is doing what they're supposed to do. We can provide some mastermind to each other. We can share resources of all kinds. So for example, we build the technology. None of us are in the business of building technology, but we can certainly chip in the money and share the technology. We can share all that infrastructure, knowledge between ourselves, opportunities, and most importantly, we can share the stock in the company because this company is going to be a valuable company. And we end up with enhanced bargaining power. When we go to other companies to affect transactions, we can go as a group. One of the things entrepreneurs do very poorly is they don't cooperate very well. They don't play well in the sandbox together. So we go one at a time to try to make a deal with a company, and the company turns us away. If 30, 50, 100 companies combined into one and went together, imagine how much power we would have. And we've already demonstrated that to be true by some of the deals that we've put together with companies that are sponsoring and supporting our group. So we put together, for this purpose, the Investor Valet. Investor Valet is a cooperative organization designed for professional deal makers. It's a capital raising engine that all of us can use. It's owned by us, it's supported by us, and it's managed and controlled by us. And that's pretty significant. So if you're a professional deal maker and you don't want to go to any one of the outside organizations, this is a place where you can go and be part of what's happening and be part of this from the ground up. And here are the rules. Only equity partners in our company can use the site. And the only people who can be equity partners are sophisticated deal sponsors, which means you have a track record, you've got some background, you know what you're doing. And that would be people who are, for example, developers, operators, syndicators, lenders. And by keeping the group small, in terms of tight and the number of disciplines that we associate ourselves with, we end up keeping a great amount of control, and we can end up producing enormously terrific product for consumers who want this. Whereas other platforms curate deals, we curate deal makers. We are entirely focused on deal makers. And here's what's most interesting. Does anybody here remember in the 1970s, 80s, and 90s how stockbrokers used to pick stocks? You know, they're not allowed to do that anymore. They don't pick stocks. You know why? Because they were so bad at it. These were people who were trained in stocks, and they were so bad at it that they had to stop doing it. Now they collect capital from investors, and they give it to people who all they do is manage portfolios. Regular stockbrokers don't touch that anymore. Yet we now have the wizards from wherever who think they can pick deals better than we can. So they're curating deals, telling us which deals can go on their platform and which ones can't, because these technologists, bankers, real estate brokers, and other people who aren't real estate people at all believe that they can do better at our job than we can. And you know, I'll tell you that the art of the deal in real estate is entirely dependent on the deal maker. A deal is not the same in two different people's hands. One guy is going to come out extraordinary and another guy is going to just make a big flop out of the whole thing. And why does that happen? Different people have different levels of skill, they have different levels of vision, and they have the ability to implement in different ways. And that's all what we're about. We want the ones that have track records, that know what they're doing, and that are excellent. So how do we fund deals? We have 4 different ways that we fund deals. First and foremost, because all of us are operating collectively, all of us are creating a crowd together. We're pooling our resources to build a crowd. Each of us has a mini crowd, 50 or 100 people. We put all that together, that's tens of thousands of people by itself. That's one way. Second, our broker-dealer, we've got 2 different broker-dealers. One manages the issuers, one manages the investors. This is enormously well organized, the way that we structure our transaction. They have a retail crowd that we can tap into. We have access to a registered investment advisory network of 20,000 or more professional people, each of who has a couple of hundred accredited investors as clients. And accredited investors, that's a requirement nearly for an RIA. They won't work with people that don't have enough money because they make their money based on a percentage of assets. So by pulling those people into the mix, that's powerful. And finally, we're developing a network of institutional co-investors. For example, we have a REIT that said to us, we want exposure to smaller syndicators. We want those higher yield transactions, but they can't deal with us one at a time. This is part of that collective bargaining and negotiating power. They can't take a meeting from each one of us for $1 million or $2 million deal, but they can say to me, Joel, here's 20 or 30 or $50 million. Help us spread this across your network of deal makers. We're looking for apartments, or we're looking for ground up development, or we're looking for lending, or we're looking for assisted living deals. And we can say, this guy's got a $2 million one, what do you want to put in that deal? So we have an enormous amount of power if we put our heads together, which I can tell you from experience and being in the entrepreneur business for 30 years, we're not very good at doing that. But if you can check your ego at the door, and if you can put your smart hat on instead of your think only about yourself hat on, then we could probably make some great progress together and do something that's really cool. If you're interested in this, the company's called Investor Valet. The full site will be up here pretty shortly. You can register, you can indicate that you're interested to be a promoter. Every person who drives traffic to our site, once you're one of our promoters, you're given an invitation code so that the crowd, the investors who demonstrate interest, come in and they're tagged to you forever. There's a way for us each to get paid on each other's deals. There's ways for us to make lots of different money in lots of different ways from all the different things that are happening. We have a whole series of revenue structures that are built in for us to help each other. We have twice annual board meetings. We get together, we talk about how we're going to organize this company and what progress we've made in the last several months. So we're already at 35 groups. We'll be at 50 or 100 here probably before the year's over. So we're working hard, we're making great progress, and if you want to learn more about this, certainly you're welcome to reach out to me, joel@investorvalet.com. I look forward to having you join us, and I'm happy to take a few questions.
What's the smallest deal you take?
Well, we think that in a Title II environment, that right now crowdfunding, the sweet spot for crowdfunding in this environment, we think is about $700,000 to $2 million of equity raise. And it doesn't have to be equity, it can be debt too. But it really falls into that range. Now you can leverage that up to 5 million, let's say 2 million goes to 5 million, give or take. So that's kind of the ballpark right now. But I'll make a prediction. And the prediction is that this business isn't going to be called crowdfunding for very much longer. Pretty soon it's just going to be called funding, because this is how it's all going to be done. Everything's going to run through platforms. And I'll say a couple other things. The platform really serves 2 purposes. And this is really, it's important to think about this. Number one, the platform is a lead generation tool. It will expose your opportunity to people that would never have seen it before, which by the way, it's good for us, but it's also good for investors. There's 9 million investors that are accredited out there. Of those 9 million American accredited investors, they're looking for us too, but do you think it's in Wall Street's interest to let them have access to us? Do you think that the brokers, the financial advisors, the registered investment advisors want them to have direct access to us? They don't. That way, if we allow the group to come through the broker-dealer in the right way and we do it properly, we can bring that in. There's a lot of talk about how do we expand the crowd fast. We expand distribution. You want to sell a lot of stuff? Put your stuff in more supermarkets. How do we do that? By putting this into the hands of tens of thousands of broker-dealers or hundreds of thousands of advisors over time, because they know where all the money is, and they can help us build the crowd too. There's lots of ways that happens. So for all these reasons, we know that this is going to grow. We're telling people right now 700,000 to 2 million, but we're talking to a REIT that's got $1.5 billion under management. It's too big for us right now, but they want in. They want to be part of the game. They don't know how to do it themselves. They don't especially want to spend $1 million to build all this technology and go through all the hoops and everything that needs to happen, but they want in. And that's what's happening, is that more and more companies are telling us they want to participate, they don't know how, they don't want to join a generic group, they don't want to build their own thing, they're not getting their deals turned on by any of the bigger platforms. So this is something that's really cool. Yes, sir.
Joel, when you go in with all the different syndicators to EDs, is there due diligence of looking at each deal individually, or is it kind of brought in as a group, or how do you get to their compliance and their due diligence?
So here's what happens. There are two levels of due diligence, and this is why there's one broker-dealer that represents the issuers, and there's one that represents the investors. The issuer, and all of us are issuers, the issuer goes through two levels of due diligence. There's objective due diligence, which is, where's the property located? Let's see some pictures. Is there really an escrow? Is there really who owns the property? The basic yes, no, factual type of questions. The second set of questions are those that the broker-dealer has to answer under its FINRA requirements that say, subjectively, the subjective due diligence, is it a good deal for investors? Now, this is a hard one for broker-dealers. Remember I said at the beginning that there's a convergence between the public sector, the public markets, and the private markets? The public markets guys who are really trained in equities and bonds, they really want exposure to real estate, but they don't understand the underlying asset like we do. So they really need some guidance from us. This is a learning process. This thing, you don't turn the light on and it's ready to go. I mean, we have to educate these advisors. I mean, part of what's going to happen after we've gone through the due diligence and all the things happen, these financial advisors, for example, we don't just send the thing out and they start lining up, because they don't understand it. They might not even know what a preferred return is in some cases, because it's not really relevant in the normal equities business that they all run. So what we want to do is we want to set up a situation where every week, every time a new product comes onto our platform from one of our sponsors, we have a marketing campaign. And part of the way our marketing campaign is going to work is we're going to set up a studio. We have a whole series of technology initiatives in place where you'll be at your office, I'll be at my office, and I'll interview you. And I'll say, hey, listen, tell us about this deal. Well, here's the new deal I'm doing. Gee, that sounds like it could be a little dangerous. Where's the risk factors? What's the upside? How does it work? We might have to spend some time educating these investment advisors how this works. But do you think we're going to get an enormous amount of loyalty and benefit by educating these people about how it all works? I'd say we will. And I can tell you with certainty that amateur and part-time investors who are going to a lot of the other platforms will not be sellable by the professional investment advisors. It won't be possible. They can't represent those guys. They're looking for higher level, better promoters. And so by us combining, I think at the end of the day, this game's going to be about deal flow. 90% of the platforms that have already started, the guys that were going to these conferences 3 years ago when many of us started going, they're not here anymore. They're all out of business. Why are they out of business? A lot of them, it's because, well, number one, they were either technologists, or they didn't have deal flow, or they had part-time jobs, or they had some problem. This is not a venture finance company. This is an internally financed deal. All of us put a little money in the pot, and we've made it work. And that's the way that this works. We are totally independent. I was in the venture business for 18 years. I know how this game works. I sold one of my companies to a Fortune 500. I've been through the game. It's not a game that I want to do if I don't have to. So that's why we're all putting in some dough, and we're all running this company the way we want to run it. That's it. Yes, sir.
I've been hearing about a bunch of guys talking about real estate, and you talk about, and I totally agree that the technologists and bankers don't have, it was mentioned yesterday, it's the real estate DNA, I totally buy it. What would be also helpful to hit is that where we are in the cycle, there's going to be a crack. There always is. Real estate
Yeah.
I had a question. What's the average duration of your deals?
You know, most guys are doing deals that are 3 to 5 years long.
Is there any plan for you to do secondary market?
Well, let's talk about secondaries, because this is a brilliant thing. It's come up many times. The private placement market is especially difficult to organize around secondaries, because in secondary means primary, like an initial public offering, is when I sell a share, you get the share and I get the money. Secondary means that you guys are trading the stock between each other and it doesn't affect the primary company. So the secondary market, which is really important, and the secondary does not exist in the private placement market right now, but as more people get involved, more people are going to want to have access to a secondary, because things happen in their life and they got their 50 grand, maybe it's worth 45, but they'd rather take the money and they just want to get their cash. Right now that doesn't exist. One second. So that doesn't exist right now. So what needs to happen is that we need to organize things in a way where that can. The difficulty in private placements is that some private placements have a call feature. Some have an 8% preferred, 9%, 7%, 6%. There can be voting right differential. I mean, there's a million things that are different, and an investor will have to read every single document. Now, that's the hard part, but here's the beauty of 30, 40, 50 of us getting together, 100 groups together, is we can have some level of standardization. So we can probably create a more sophisticated secondary because of that reason than we might otherwise.
You can get juices for these private placements.
Yeah, well,
right?
that's the broker-dealer's going to assign that to everybody.
Mm-hmm.
That-
Yeah, it doesn't, you can do it,
Yeah.
yes, but you can do it on your own. You don't need to be a broker-dealer, you can just assign to it.
Cool.
I'll leave you alone.
Great, thank you. Last question.
What about the NASDAQ private market?
I don't know.
It's a secondary market for private shares.
Yeah, I don't know. I'm not familiar enough. Any other questions? All right, guys, listen. Thanks for sharing your time.